In this video, we're going to gain a better understanding of budgeting. What is budgeting? Recall that management has three broad functions: planning, directing, and controlling. Planning is when management sets goals, both short-term and long-term, for the company and determines how those goals will be achieved. Directing is the implementation of the plan, as well as the methods the company will use to motivate the employees to do their best for both the company and, by extension, themselves. Finally, controlling is when management compares the outcome of their plans and uses that feedback to determine how to move forward. Budgeting is part of planning for every organization. The budget is a formal plan, in financial terms, covering a period of time in the future. For example, a budget may be for an upcoming month, quarter, half year, or even longer, such as 3 to 5 years. The budget is the main method that management uses to communicate the goals of the organization. In addition, budgeting is part of controlling. Actual results are compared to the budget to evaluate the performance of both management and employees. This provides evidence that both management and employees are moving towards the company's goals. The goal of the budget is therefore to ensure that the employees focus on efficiency and ensure waste is minimized. This understanding of what budgeting is helps us to understand the benefits of budgeting. First and foremost is that budgeting requires that companies plan ahead, formalize their goals so that they can communicate them to everyone else in the organization. Second is that it provides a method of evaluating the performance of both management and employees. By having a formalized plan for the future, it can be used against actual results to determine if the company is achieving their goals. It can be used to determine if the company has met their targets for such things as sales revenue, production costs, selling and administrative costs, and operating income. Because the budget provides a plan against which to measure actual outcomes, it can be used as an early warning system. If actuals are not in line with the budget, management can act proactively to change moving forward. In every organization, the budget can be used to integrate the many different divisions within the organization, ensuring they all work towards the overall goal. Finally, the budget is used to communicate the company's overall goals and motivate management and employees to meet those goals. You can see that budgeting is an important tool for every organization, regardless of whether they are small or enormous. So, what is included in the budget? First, let's be clear that we're going to be covering the budget for a manufacturing organization. Budgets for retailers or service organizations will have some similarities, but also differences. So we're going to start with budgeting for a manufacturer. A budget is actually a series of interrelated schedules which, combined, provide a plan of action for a specific period of time. That series of interrelated schedules is called a master budget, also sometimes a static budget. But what is included in the master budget? The master budget includes the operating budgets, schedules which are used to prepare the budgeted income statement. The master budget then uses the information from the operating budgets to create financial budgets. These budgets determine how money will flow in and out of the organization. In addition, the financial budget includes the preparation of the budgeted balance sheet. Let's look at the individual schedules that make up the master budget. First, we produce the sales budget. This determines the units the company is expected to sell, as well as the sales revenue generated. The information from the sales budget is used to produce the production budget. This budget determines the number of units that need to be produced in order to ensure that there is inventory on hand at all times to meet sales needs. The information from the production budget is then used to produce three budgets. First is the direct materials budget, also called the raw materials budget. This budget tells purchasing the quantity and target price for all the raw materials required to meet production's needs. The production budget is also used to produce the direct labor budget. This budget tells human resources and production how many employees need to be hired and what it will cost in wages. Finally, the production budget is used to develop the manufacturing overhead budget. This budget determines the variable and fixed overhead costs that can be expected given the level of production planned. You can see that these three budgets, which stem from the production budget, cover all the manufacturing costs to produce a product: direct materials, direct labor, and manufacturing overhead. The next budget is therefore used to determine period costs. This is a sales and administrative expense budget, also called the operating expenses budget. It covers all of the period costs, such as sales commission, rent, head office salaries, advertising, shipping, the list goes on. Any and all period costs are included in the sales and administrative expense budget. All of these previous budgets are used to produce the budgeted income statement. The budgeted income statement tells the organization what they can expect to earn in operating income over the upcoming period. This budget is critical for evaluating whether or not the organization has achieved their profitability goals. The budgeted income statement is the last of the operating budgets. We can then use all of the operating budgets in order to produce the financial budgets, the first of which is the capital expenditure budget. This budget shows the company's purchases of new property, plant, and equipment, also called capital investments. The next financial budget is the cash budget. This budget shows the expected cash inflows and outflows of the organization and is considered the most important financial budget because no organization can continue if they don't have enough cash to meet their obligations as they come due. The cash budget is produced this late in the budgeting process because it uses the information from all the other budgets to determine both the inflow and outflow of cash. Finally, the last budget is the budgeted balance sheet, which shows what the organization project with regards to their financial position at the end of the budgeting period. All of the information from the other budgets are used to produce the budgeted balance sheet, which is why it's the last budget in the budgeting process. It is these interrelated budgets, both the operational budgets and the financial budgets, which make up the master budget. As always, the best way to demonstrate the concept is to walk through an example, which is what we'll do in our upcoming series of videos. As always, thank you so much for watching.